Asalam-o-Alikum. In today's class, we will discuss some objectives of monetary policy and fiscal. So, what are the main objectives of fiscal policy? In order to stabilize the pricing level in the economy, the main objective is to achieve and maintain the level of employment in a country. Also, stabilize the growth rate in the economy. Also, promote the economic development in a country. In order to maintain the level of balance of payment in the economy. Various types of fiscal policies. We discuss all of them one by one. Number one is the contractionary fiscal policy. This involves cutting government spending and raising taxes. So when the taxes are rise and the government spending are low, it means if there is inflation in the economy and they try to control the inflation, so they apply the contractionary fiscal policy. Uh, in contractionary fiscal policy, they contract the prices in the economy. So when they contract the prices and they rising the taxes, at this time the government revenue is more than government expenditure. Government expenditure. So there is the budget surplus in the economy. The second one is the expansionary fiscal policy. An expansionary fiscal policy, as we already discussed, the contractionary fiscal policy, they contract the prices, and the expansionary fiscal policy when there is high prices in the economy. So at this time, they uh, generally used to give a boost to the economy and speed up the growth rate of the economy. So they use during this policy during the recession period when the growth in the national income is not enough to maintain the current living of the population. So at this time they increase the government expenditure and contract the government revenue. So government expenditure is more than government revenue, and this is at this time this is the budget deficit of the economy. The third one is the neutral fiscal policy. Neutral fiscal policy means there is a balance between the government spending and the taxes. So change in government spending change in government spending equal to government change in taxes. So the overall budget outcome will have neutral effect on the level of economic activity. What are the difference between the fiscal and monetary policy? We will discuss objectives of the fiscal policy as well as of the monetary policy. So, objective of the fiscal policy is to change the aggregate demand to control inflation and to overcome recession. Causes a deliberate change in the government revenue and expenditure with a view of influencing the price level and the quantum of national output. Now we will discuss some objectives of the monetary policy. The first one is to maintain the price stability full employment and economic growth. It regulates the money supply and cost and availability of credit. Also influence and borrowing rate of commercial banks. So both the monetary and fiscal policies are the instrument that are available to different arms of the government through both are formulated and implemented by the same government. They are done by different departments, monetary policy through central bank and fiscal policy through the treasury or the ministry of finance. Now we will discuss some other differences like the monetary policy controlled by the Central Bank, Federal Bank of USA, Central Bank of India and Central Bank of UK, etc. On the other hand, the fiscal policy is controlled by the Ministry of Finance and central government like USA, India, UK, etc. The monetary policy focus is on the economic stabilizing. On the other hand, the fiscal policy focuses on the economic growth area. The monetary policy targets are to overcome or control the inflation in the economy. On the other hand, the fiscal policy target is to social and public welfare. Monetary policy has no specified period. It can change any time as per situation, and the fiscal policy accounting period is specified like it would be 1 year. Monetary policy features contain economic stability, money control, investment creation, adv- advisors to the government. On the other hand, the fiscal policy has the feature that economic welfare, money control of government, inflation control, and employment generation. Fiscal policy is nothing but money policy of the government. For example, generation of money and expenditure of money. It has two sides. Number one is income, the second one is the expenditure. And it is generally formulated by the executive, for example, Ministry of Finance. Its main tool is budget through which government try to bring dynamism in the economy. Expenditure reforms like FRBM Act, income side reform or GST. This is one type of tax. On the other hand, we focus on the monetary policy, so it is concerned with the supply of money, for example, controlling inflation and ensuring liquidity. It is about money supply and demand. Money supply and money demand. It is formulated by the central bank of the country, for example, Reserve Bank of India, RBI, or the central bank. It has its own tools like repo rate, reverse repo rate, or open market operation, etc. These are tools we already discussed in the previous class. And the last one is the monetary policy reforms monetary policy committee.